Greetings, good morning, and thank you for joining us today. I'm Steve Kamen, a senior fellow here at the American Enterprise Institute, and it's my pleasure to welcome you all, as well as our expert panelists, to this morning's event on central bank digital currencies, or CBDCs, for emerging market economies. Let me also mention what a pleasure it is to be moderating my very first in-person AEI event. In fact, this is the first time I've worn an entire suit in 2 years. We have a real live audience here, and in addition, we're webcasting to a virtual audience as well. So let's talk a little bit about central bank digital currencies. If you're in this audience, then unless you're here for the free cookies, you probably know what a CBDC is. But just to get everybody on the same page, a CBDC is a particular form of digital or electronic money. Now, of course, we already have lots of electronic money, such as credit cards, debit cards, Venmo, Zelle, PayPal. And that's not to mention cryptocurrencies, such as Bitcoin, Dogecoin, Ethereum, and other cryptocurrencies that you may have heard of or even lost money on. But a CBDC isn't just any kind of electronic money. It's issued by and it represents a liability of a nation's central bank. And so it isn't just as good as official money, it is official money. Now you might ask, well, if you can use credit cards and debit cards and PayPal and Venmo so easily, why do we even need CBDCs? And that's a great question, and that's one that governments around the world are currently grappling with. In fact, over 3/4 of the world's central banks are currently exploring the desirability and feasibility of issuing CBDCs. Among the advanced economies, Sweden's Riksbank seems nearly dead set on issuing an e-krona, while the Bank of England, European Central Bank, and Bank of Canada are giving CBDCs serious consideration. The Fed seems a little bit more uncertain about it, but it is nevertheless going ahead with some pretty serious technical experiments. Now, surprisingly, a lot of the interest in CBDCs is coming from emerging market economies. China is very close to having a fully operational CBDC. Several countries in the Caribbean have already issued them, and many other countries in Latin America, Africa, and Asia have expressed strong interest. Now, given that a lot of these economies have much less developed financial systems and much less developed technological infrastructures, what explains their strong interest? And more broadly, how do the costs and benefits of CBDCs balance out for emerging market economies? And what are the challenges of issuing these instruments? Well, that's what our expert panelists here are here to tell us about. And in fact, I can't think of a better panel to shed light on these important issues. So, in the order in which they will speak, they are first at the other end, Eswar Prasad, who is the Tolani Senior Professor of Trade Policy at Cornell University. He's also a senior fellow at Brookings, right next door to us, and a research associate at the NBER. He was previously at the IMF, where he served as chief of the Financial Studies Division, and before that as head of the China Division. He's got a huge publication record, including numerous articles in top academic journals, as well as many books, some of them on the international roles of the dollar and the Chinese RMB. But his latest book is the reason why he's here today. Let me dig that up. Here we go, a little free advertising. The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. This encyclopedic book tells you everything you always wanted to know, but were afraid to ask, about fintech, cryptocurrencies, and CBDCs. I would tell you that it's available at a bookstore near you, and that's exactly correct. I got this a few blocks away at Kramer Books. A mere $35 plus tax. All right, moving on to our next two panelists. Both of them work for the Bank for International Settlements, or the BIS. Now, for those of you who aren't familiar with the BIS, it's a global organization of central banks which focuses on fostering international cooperation to promote macro and financial stability. Now, among many other things, it provides forums for central bankers to exchange views on recent developments and policy issues. It hosts the Basel Committee on Bank Supervision. And more recently, as Miguel is going to discuss, it's created a network of innovation hubs to support research into fintech innovations in the public domain. So starting first with Alexandre Tombini, he has a long and distinguished record of public service. He's currently the chief representative of the BIS office for the Americas, which is located in Mexico City. Before joining the BIS, he was the executive director at the IMF, representing Brazil, Ecuador, and several other Latin American and Caribbean countries. And then before that, he served as governor of the Central Bank of Brazil from 2011 to 2016. He's also held many other prominent positions at that central bank, including deputy governor for financial system regulation and deputy governor for economic research. Now, full disclosure, I've been working with staff in Alexandre's office on research into CBDCs, so if I don't attack him savagely during the Q&A part of our session, you'll understand my conflict of interest. All right, our last panelist is another longtime central banker, Miguel Diaz, is currently head of the just opened Toronto Center, which is one of those BIS innovation hubs that I mentioned. It represents a collaboration with the Bank of Canada, and as Miguel will be explaining, it'll serve as a key platform for central bank innovation in the Western Hemisphere. Now, before joining the Toronto Center just this year, Miguel served as the Director General of Payment Systems and Market Infrastructures at the Bank of Mexico, where he guided the development, operation, analysis, and regulation of financial market infrastructures, and which also included the modernization of the country's primary payment system. He's also currently the chair of the Consultative Group on Innovation and Digital Economy, which is established at the BIS office in Mexico City. So after our panelists have completed their presentations, we'll take some questions from our audience. And if you in the virtual audience have any questions that you'd like to ask of the panelists, you can send them to John Kearns via email or Twitter, as indicated at the bottom of your screen. So without further ado, let me give the floor over to Eswar to start our discussion.
Thank you, Steve, for that very kind plug for my book. I shall go right back to my office after the event and check the Amazon rankings of the book, which I'm sure have jumped thanks to you. Or perhaps Kramer Books will be the place where people go. It's very nice to be on such a panel with distinguished former and present central bankers who've done very important work in the trenches of monetary policy. So I speak to you more as a theorist rather than a practitioner. And it's worth thinking a little bit about the central bank digital currency experiments that are ongoing around the world and to think about what may be driving central banks to do this. At one level, one might think about it in a very simplistic way as central banks trying to maintain the relevance of the money that they issue at the retail level. Because the reality is that cash is disappearing very fast. Digital payments of various sorts are beginning to take over. So if central banks want to keep their money relevant, you might think that this is crucial. But it turns out that issuing physical currency is not really a critical component of a central bank's functioning or its ability to function. A central bank can do perfectly well in terms of its ability to conduct monetary policy affecting the cost of funds by and large without necessarily issuing currency. So the question then becomes, what is the point of a CBDC? And the point seems to depend on the country's circumstances. So there are many countries that are undertaking CBDC experiments, or indeed, like the Bahamas, have gone ahead with issuing nationwide CBDCs because they view it as a pathway to financial inclusion. The idea being that you could see a CBDC as a way of giving everybody in the economy, whether a consumer or a business, a mom and pop operation, or somebody with a very low income or very low net worth who doesn't even have a bank account, very easy and widespread access to a low-cost digital payment system. And digital payment systems have a lot of boons for consumers and businesses. For businesses, the hassle of dealing with cash, the concern about loss, theft of cash, are all real downers. For consumers, the convenience of being able to make payments with a swipe of a phone is certainly something that makes it much more attractive in many ways. And one can also think about a CBDC, depending on how it is set up, as also providing a portal for basic banking products and services. So essentially, one can see a CBDC as a pathway to broadening financial inclusion, which is a significant issue in many developing economies where a large proportion of the population is unbanked or underbanked or doesn't have easy access to products for managing savings, credit, or risk for that matter. Then there is a Swedish case that Steve referred to, and there the motivation seems to be quite different because in Sweden, the private sector is doing a perfectly good job of providing low-cost digital payments to anybody who wants it. But the Swedish central bank, the Riksbank, is a little concerned, apparently, that leaving the entire payments infrastructure in the hands of the private sector could leave it vulnerable to technological or confidence issues. So if you think about any part of the payment system, building up risks, perhaps other parts of the payment system, seeing counterparty risk arising, will stop conducting payments with that part of the payment system, and you could very soon have the payment system freeze up. And essentially, given that payment systems are the lifeblood of modern economies, you could have economic activity grinding to a halt. Now, one can think about the central bank essentially, therefore, seeing a CBDC as a backstop and, in a sense, consistent with its financial stability mission to make sure that the payment system and indeed the entire financial system maintains a resilience to these sorts of vulnerabilities. Then there is China. As with many other things, China is sui generis. In China, there are two payment providers, Alipay and WeChat Pay, that have dominated the payment system. Virtually everybody in China seems to use one of these. My last international trip before the pandemic was to Beijing in December 2019, and I felt quite anachronistic on the streets of Beijing, trying to use my yuan notes for either making small purchases or paying a taxi. It seemed like nobody else was using cash. But in China, I think the central bank, in addition to wanting to retain the relevance of its money at the retail level, which the PBOC, the People's Bank of China, has explicitly stated as an objective, is also concerned that leaving the payment system in the hands of these two payment giants has negative effects on competition, on innovation in the payment space, and therefore the ECNY project is seen as a way of essentially promoting easier entry into the payment space so that it's not dominated by these two payment giants. Of course, as the government in China has noticed, these two payment giants have also been hoovering up a huge amount of data that until recently they were not willing to share with the Chinese government. And that too is a concern that seems to have led to the ECNY project moving forward. So there is this range of motivations at play, but I think it's worth stepping back a little bit and thinking about what the benefits and costs of a CBDC are, in addition to the ones I've already outlined. Some of these are particularly relevant in the Latin American case. One of the issues, of course, is that once you move towards digital payments, it brings a lot of economic activity out of the shadows. It makes it much harder to disguise economic activity and keep it from the prying eyes of the tax authorities. I know Steve's present colleagues at the AEI may view the prying eyes of the tax authorities as something from which most economic activity should ideally be shielded, but a majority of people might think that certainly without broadening, without increasing tax rates, if you can broaden the tax base, that is certainly going to be good. And in addition, with CBDCs that ultimately are going to leave a digital trail, it'll be harder to use official money for illicit purposes, for transactions that the government wants to discourage, related to, say, drug trafficking, money laundering, terrorism financing, and so on. So there are these benefits. And I've argued in my book that in addition, a CBDC, if set up as an account-based CBDC, could also have some advantages in the sense that it gives monetary policymakers an additional set of tools that are particularly relevant in perilous economic times. And We've certainly lived through very perilous economic times in the last couple of decades. But certainly if you had an account-based CBDC undertaking things like negative interest rate policies, where you could basically draw down the balances on CBDC digital wallets, or you could even undertake policies such as helicopter drops of money, where essentially you're providing, for example, coronavirus stimulus payments to a large part of the population without relying on, say, prepaid debit cards or checks, which could get lost, mutilated, misappropriated. All of these become a lot easier to deal with if you have digital money. But of course, there are questions about whether you can maintain the integrity of central bank money once you start using all of these features. And this, I think, is a real concern. Certainly, you can have central bank money that could even have expiry dates, which would be great in terms of economic policy. Because if what you want to do with a stimulus payment is to stimulate economic activity, then attaching an expiry date to a particular unit of digital money would certainly facilitate that. But then you can very easily see that many of these issues could come back to bite central banks themselves. In fact, the more I've thought about this, the more I've come to think that the biggest risk to issuing a CBDC might be to central banks themselves. Why is that? Because if you have different units of central bank money that have different properties, that could affect the integrity of what we think about as central bank money. Likewise, if you think about, trying to make sure that the government can easily uncover the digital records of payments using a CBDC, you could see the central bank essentially being seen as an agent of the government. Likewise, if you think about these helicopter drops of money, they're going to be a lot easier. But helicopter drops of money, while they sound like monetary operations, are at heart fiscal operations. And if the central bank is seen as the agent of the government, again, you could see the central bank's effectiveness and credibility coming under threat. Now, there are other concerns, of course, with the CBDC, including the potential disintermediation of the banking system. If you have central bank accounts that people have access to, potentially, it's hard to imagine that any private payment provider could compete with a government payment provider, so you could lose competition in the payment space. It turns out there are ways, using both technical and conceptual design, that you can mitigate, if not entirely eliminate, these risks. And the experiments that are ongoing in countries like China and Sweden are showing us ways to do this. Even in the Bahamas, we've learned some useful lessons. The Bahamas has dealt with one potential problem, that you could have a flight of deposits from the commercial banking system to central bank digital currency accounts simply by putting a cap on the amount of money that can be held in a CBDC account. Likewise, if you think about this notion of blocking innovation in the payment space, what Sweden and China are moving forward with is a two-tier approach, where essentially you have a payment infrastructure being provided by the central bank, and the central bank provides the CBDC in the form of digital tokens that it then sort of passes on, conceptually speaking, to commercial banks which maintain the CBDC digital wallets. So the front end, in terms of provision of payment services, is still managed by commercial banks, other payment providers, perhaps even including telecom companies. The central bank just provides the payment infrastructure at the background, much like it does with cash right now, where it provides cash to commercial banks who then go out and distribute it to their customers, who could be businesses, who could be households, in exchange for reserves. So one can see a way to mitigating many of these risks out there. And ultimately, I think the question is what the user case is for a CBDC in a given country. I spoke about China. India is another example where the private sector is doing a very good job. And in countries like this, somewhat paradoxically, the question about whether there is a strong user case for a CBDC becomes really important. Why do you need a CBDC when the private sector is doing a perfectly good job of providing payments? I recently gave evidence, as it is called, before a House of Lords Parliamentary Committee, because in Britain there is the same debate going on, much like in the case of the US, about what the user case is. What is the problem to be solved that cannot be solved by alternative technologies? In the US, Fed Now, which is a suite of changes to the payment system that has been proposed by the Fed, is coming along. So if we had better payment system, do we really need a CBDC in order to supplement what is going on? My view overall is that there are certainly certain benefits and many risks to be dealt with. But I think with appropriate design choices, you can think about a CBDC still as providing a platform that you can think about as enhancing competition in the payment space without the government intruding where it ought not to intrude. So I think there is a case to be made on balance, although this case is certainly not an open shut one, that you can think about designing a CBDC in such a way that it really serves as a backstop and fosters private sector competition in the provision of payment services rather than displacing them. Certainly in some countries, you might see a CBDC as a pathway towards accomplishing a broader set of economic and societal objectives. But here too, I think the case is not entirely obvious, but I think by and large, if you think about these balance of risks and benefits, there is a case to be made that a CBDC can accomplish a variety of things. It may not be the best way to do this. It might not necessarily be the most efficient way to do this, but it is certainly one very useful tool. And I think in terms of the implications on monetary policy and so on, it can certainly have many benefits. So as we think about Latin American countries where the shadow economy tends to be very large, where there are problems such as corruption that still remain rife in these economies, certainly having payment systems that leave a digital trail will act as a disincentive for using official money for illicit purposes and even for fueling corruption and so on. Certainly, unless you change the incentives of corruption, just having digital money rather than physical money isn't going to solve any problems, but at the margin, it can certainly help. But for emerging market countries, I think it's not just CBDCs, but digital payments that are really becoming an issue. And I'll conclude with this set of remarks. I think the reality is that international payments, thanks to these new technologies brought about by fintech, but also through wholesale CBDCs, is reducing impediments to international financial flows. This is going to have many benefits. Households in developing countries will have better access to international portfolio diversification opportunities. Small businesses and medium-sized businesses will have access to a global pool of capital, but it's going to come with a cost that capital flows are going to become much harder to control. And for emerging market economies that are already beset by capital flow volatility and exchange rate volatility, the problems, if anything, are going to become even less tractable. And then there is the question of monetary sovereignty. I think as central bank digital currencies become more prevalent, and I think this is really the way we are going, some countries may end up doing it slower than others, but ultimately the reality is that CBDCs are coming. If you have digital versions of the Chinese renminbi or the digital versions of the US dollar available, or even if you had stable coins issued by a major corporation such as Amazon, or if Zuck bucks start becoming easily available around the world, it's very easy to see those currencies or stable coins being seen as much more trustworthy than the domestic currencies, especially if you have small countries or countries without credible central banks or credible currencies. So I think there is potentially a real shakeout coming among the third tier of currencies, which could face existential threats. So one might see the development of CBDCs as sort of a defensive mechanism to at least slow down the process, if not control it altogether. So I think the world of CBDCs ultimately is going to be an interesting one, and this is certainly one that we are moving towards. I know that the Fed has been approaching this in, I think, a very sagacious manner, laying out the issue for public debate, thinking about the pros and cons, and arguing that the Fed will not move forward unless there is broad political and public support. But I think the reality is this is where we're going, and it's going to be, in some ways, an interesting world, and in some ways, a scary one.
Eswar, thank you for that very stimulating and comprehensive discussion. I always prepare a few questions, kind of like to ask, kind of like in between our presentations. Unfortunately, you've hit nearly every one of the questions that I was going to ask with your presentation. But let me follow up on one point that you brought up toward the end of your discussion, looking at the issue of CBDCs and cross-border payments. And I want to ask about it in respect to the Chinese experiment with CBDCs. China seems to have a sort of a conflicted attitude toward the international role of the RMB. On the one hand, it seems to want to promote an international role for the currency, through its many swap arrangements with different countries, its creation of an international interbank clearing system, the CIPS. And also the ECNY seems to be in part motivated by some interest in promoting the role internationally of the RMB. But on the other hand, it still seems to lean toward tightly controlling financial transactions within its borders and doesn't seem to be inclined to either fully open the capital account or float the currency. So kind of how do you see these motivations playing out against each other? And if the Chinese created a fully operational, internationally usable ECNY, do you see that as something that could make some significant inroads on the international role of the dollar?
I think not. If you view digital international payments, most of them are largely digital already, so it's hard to imagine that easy access to a digital version of the renminbi is going to substantially alter its role in international finance. But the other thing that you mentioned, the cross-border interbank payment system, CIPS, is a potential game changer because it can more easily communicate directly with the payment systems of other countries. It also has messaging capabilities that could potentially displace SWIFT. And SWIFT is a business model that is hard to see as being sustainable because it's just a protocol that allows for getting around technological, language, and other barriers in terms of messaging. And this is ripe for technological disruption. So one can see CIPS making it easier for China to conduct transactions with other countries, including, say, Russia, India, and many other emerging market countries, without having to go through a vehicle currency such as the US dollar. So I think the reality is that even if this did not happen, what we are seeing in the last few weeks with the US very effectively, and the West very effectively using their financial sanctions against Russia, I think the reality is that technological developments were going to lead to an erosion of the dollar's role as a payment currency. I think it will still remain probably the most important payment currency, if not one of the most. I still think it will remain the most important reserve currency by far, because for a reserve currency, you need many other attributes, including institutional frameworks. So I don't think the digital version of the renminbi will be a game changer, but one can certainly view not only the CIPS, but also the notion that China could make the use of the ECNY easy for many developing countries that have very strong trade and financial linkages with China, allowing the ECNY to get a lot of traction in certain economies. So not on a global scale, but in certain economies that have very strong linkages with China, one can see the ECNY gaining more traction. So it could gain somewhat more traction as a reserve currency in addition. But again, I don't think it's going to be a dramatic game changer.
Very good. Well, I'll tell you what, why don't we now shift the focus from China to Latin America and hear what Alexandre Tombini has to say.
Thank you, Steve, for inviting me here. Thanks to the American Enterprise Institute for having this panel with my colleagues here. So it's really good to be, after 2 years, to have something in person and break the ice here in your institution. So, I'm going to put some numbers on what Professor Eswar Prasad, I think he covered all the analytical corners of this. So you see some repetition here, but I'll put some numbers on the Latin American and Caribbean case, which is incidentally heavily based on a paper that was commissioned to a few colleagues and also Steve on how is the landscape for central bank digital currency in Latin America and the Caribbean. And also a previous incarnation of this paper where we look into the fast payment systems in Latin America and Caribbean, Mexico with the CODI. We have here the father of the CODI with us, Miguel, and the Brazilian PIX. So we cover the FPS, which is sort of a contiguous point in a continuum of sort of innovations in the payment landscape, but also more broadly in the financial the financial system. Before going to my presentation, I just wanted to complement what you said about the BIS. BIS is not as known as other IFIs here in the Washington area. So we have 63 central banks as members. We are a bank, so we are the bank for the central banks. Now with Mexico, since March 2020, we opened a trading room in Mexico, so now we trade 24/7, starting with Hong Kong, then Europe, and then the books go to Mexico around the clock. So we are serving the 63 central banks plus the whole central bank community, which does business with us, and we help them to invest their reserves. And we are a forum, and we want to think that we are also a think tank, because we do produce like cutting-edge research on many areas pertaining to the universe of central banks, including now innovation and digital economy, which is part and parcel of the BIS 2025 strategy, which is being led by our general manager, Agustin Carsten, that you might, of course, know him. And so one of the areas which we have emphasized the most in this agenda is the innovation to help central banks sort of navigate this very open field, I should say, is still of the digital payments, the digital currencies. So this is the institution. We have two regional offices, one in Hong Kong, another one in Mexico that I'm chairing as we speak. So let's go to my presentation, basically motivations for issuing CBDCs based on a BIS survey. So I'll put some numbers here focusing on this part of the world, Latin America and the Caribbean. So potential benefits of CBDC versus cost and risk, basically what Professor Prasad said. I will try to bring some new elements to the discussion here, but I will try not to repeat too much what has been said. And then some concluding remarks. What have you learned so far with the experience of central bank in the region, sort of digging into this new area? So this is the landscape. This is based on a 21 central bank survey between 2020 and 2021, only in the Americas region, not the US and Canada, but south of the Rio Grande, basically every central bank was surveyed in this work. There is a clear interest in CBDC. 85% are engaged. 85% of the central bank community is engaged on CBDC research, different levels of depth as now, and in different positions now in terms of the advancement in this area. We have a higher interest in Latin America and the Caribbean on retail CBDCs as opposed to wholesale. So when you see in the center panel, you'll see that the Latin America, which is the green bar, is retail more than the green circle, which is the global research survey that we made. So clearly here, there's a preference for investing on the retail CBDC in the region. And having two live experience, you mentioned, Professor Eswar, the Bahamas. There is the Eastern Caribbean Central Bank jurisdiction, which involves 8 small islands in the eastern part of the Caribbean. It also has a live CBDC experiment. You have pilots in the past in Uruguay. We had a CBDC some years ago in Ecuador, and we have now a pilot being implemented in Jamaica. So when you take together, there is explicit interest from Mexico, from Brazil, and from other jurisdictions. So this is, I would say, one of the most dynamic, if not the most dynamic, regions of the world as far as work on CBDC that goes on right now. So the main motivation, as was mentioned here in Latin America, given the large informal sector, given the unbanked population, etc., the main motivation that was surveyed is financial inclusion. And the second one, efficiency and safety of the domestic payment. I think efficiency is an instrument, or it's a way to get to more people, not only in the payment landscape, but also in other financial services. Because as you said, payments is digital payments, kind of the gateway for the deepening financial inclusion. So the anticipation of private cryptocurrencies or stable coins was not a major factor behind this interest with CBDC in the region, but this was the result from the survey. In our bilateral conversation, yes, there are jurisdictions which are concerned with this capacity of stable coins, like substituting currencies or taking over sort of the payment landscape. So it was also a response to that, less reflected in the survey itself, but in the conversation. So the idea here, as was mentioned, informal economy, lots of use of cash. Of course, the pandemic came, and I mean, the motivation for going to a CBDC or to the digital payment system has increased a lot within the last couple of years because of this. And here is not to eliminate cash, but to reduce the use of cash. So yes, central banks in the region are aware of the cost of handling cash. Production, distribution is not for free, it's very expensive. So reducing the use of cash also has an economic justification for that. And here we ask the question whether they are going to implement CBDC in the next, say, the short term from 1 to 3 years. So only 1/3 of the central banks have responded in this respect. The other 2/3 say, well, we are studying, we probably will go there, but not in this. So it's not for very soon a result. So promoting financial inclusion here is the most salient motivation, as I said. You see in the top graph the share of adults with access to transaction accounts. Latin America is the far right here with the least. I mean, this is on average. Of course, you have countries with specific situations here, but in Latin America, more or less around 45–50% of adult population has access to a transaction account. So this is especially important to have something that will produce greater financial inclusion, and CBDC could be that instrument. So also the fact that you have 70%, close to 70% of adults with mobile phones and 50% with sort of transaction accounts. So you see CBDC can be sort of hosted in a smartphone, in a mobile phone, doesn't need to have a sort of bank account behind it. So there is space here with the CBDC to sort of a low-hanging fruit to occupy this space that is there. Reducing informality, as you said, provided that the CBDC gets traction, and I mean, the consumers are using CBDC, so the retail sector, including the mom and pops and the small business, will have to accept this, and this is a way of going into formality. So you broaden the tax base, you regulate sectors that were not were outside the grid before. So there are benefits of reducing informality with this, and getting funds hard to reach people. This is especially important in your paper. You have the example of Bahamas, the hurricanes. So you have electricity was down in one of these examples for a week, but the banking system or the outlets of banks were down for, say, several weeks. So you could, with CBDC, maybe reach out to this far to reach population in case of emergency. So promoting the efficiency, it's sort of part of parcel of going into deeper inclusion in the economy. You have here the banking systems are not that competitive in the region. I think we have made progress, some jurisdictions more than others, but still concentrated and efficient. And you see the prices here. We have two indicators here, net interest margins. You see Latin America. It's highlighted here in the left, the largest blue bar, and then on consumer payment revenues, you see it's also very hefty what the consumers have to pay to use, for instance, credit cards in the region. Big techs has been said here. You see the Chinese reality too dominated the payment system after a while, so they were very important for financial inclusion, but all of a sudden they were dominating the system and you didn't like it anymore. So it could be very good in the very beginning, increase competition, have very low fees, but then with market power, you can take advantage of that later on. So over the medium term, this is not going to be a great sort of landscape to have in a jurisdiction here in the area. So it could reduce costs in the short run, but perhaps not in the medium to long run. So another problem is not only concentration of the banking system, but then if you allow lots of players to come in into payments and other services that, like some jurisdictions have allowed in the recent past, you might have fragmentation, which is you have the competition, but then the payment system, the private payment system, don't talk to each other. So, and then to cross-transact within this different private payment system, it might cost much more than even if you have only a single player with all this market power. So fragmentation is also an issue. So you see here that in the Latin American region, here you can see in the three alternatives: ATM, POS, and mobile money. Especially mobile money, which is closer to what we are talking about here, which is CBDCs and digital retail payment system. You see there is very little interoperability amongst different mobile money providers in the region. Again, different countries, different situation. We are using here average. So the low interoperability is a problem that has to do with fragmentation and might increase costs for consumers. So here I think CBDC could address both of the problems, the concentration and the fragmentation, by supplying or offering a common platform that everybody can use, so entry is not restricted. You have to attend some regulatory principles, but you can have banks, you can have payment service providers which are non-banks participate in this platform. This platform is open, supervised by the authority, the central bank, so to ensure fair competition. So this could free the entrance to the market, enhance competition on the one hand, but also since you have a central bank sort of sponsoring this infrastructure, you make sure that it's interoperable with other forms of payments, other forms of private money in the system, private currency in the system, like deposits, etc., credit cards, so on and so forth. So here, I think central banks see CBDC as an alternative to address both concentration and fragmentation going forward. So, but the question is, as was said here, and I mentioned in the beginning, you have kind of a continuum of alternatives in sort of modernizing your payment system. So from the RTGS systems, which were a success, like we have wholesale currencies for the last, digital currency for the last 50 years, and this has evolved into retail systems now that allow for very affordable transaction, if not for free, like we have here in CODI in Mexico, in PIX in Brazil. So the question is, why should you have a CBDC if you have a payment system, be it sort of publicly managed or privately managed, as you were mentioning, Sweden and other examples? Why should you take the additional step? And as you said, I mean, this is a claim on the central bank. When you do a PIX or a CODI, it's still claim on bank deposits or wallets. So there might be some liquidity risk, some credit risk involved. When you do a transaction between me and you using CBDC, so this is final. So this is going to be settled in the balance sheet of the central bank. So there is no reversal to that. There is no credit risk, there is no liquidity. So you can do away with some of the intermediaries. This could even facilitate cross-border. Of course, cross-border has other implications, but you can simplify the financial system with a CBDC where transactions are final, are settled in the balance sheet of the central bank. So the other thing that it could improve upon this digital retail payment system that work under the existing type of money, private money and central bank, is this idea of making money programmable, not only for scheduling payments, but also credit operations, insurance, who knows? I mean, there is an infinite of use case that you cannot imagine right now, but I mean, the world is going digital. Why should central banks be left out? And why fiat money is not going to be in this new sort of form, digital. So this is an important, some jurisdictions here say, well, we want financial inclusion, but we do have financial inclusion already. We don't want financial inclusion only in the payment space. We want financial inclusion being deeper participation of citizens in the financial system, going for the credit, insurance, etc. So that's why they see this idea of programmable money as the future that can help them sort of continue to develop the financial system and work for the economy. So the potential risks, I don't think you talk about cyber attacks. This is not particular to CBDC. I think electronic forms of payment are subject to this sort of issue. I think here the difference we discussed on previous virtual seminar, Steve, that the idea here is that the cyber attack is on the fiat currency, so it's also the central bank is on the line in a sense, right? So this has a reputational risk, but there are forms of mitigating this, of course, but this is an issue that is not particularly referred to CBDCs only, it's electronic transactions in general. This intermediation of the banking system, I think you went over sort of what are the mitigators. You do not remunerate balance CBDC. You can put limits in the volume of transaction. You can put limits on the holdings. You can do cascading. After some limit, you go for a regular central bank money, not the CBDC, or you can penalize excesses of up to a certain threshold. So there are the ways of addressing this in normal times. Bank runs, of course, the same thing, putting limits, but at the end of the day, the central bank, if there is a run from the banking system, from private money, from deposits to CBDC, the central bank will have to channel this liquidity back to the financial system in case, for instance, of a crisis situation. Greater volatility of capital flows. Yes, you can have more currency substitution, provided that the CBDCs issued by central banks are allowed to be held by non-residents freely. And what we have seen so far is that you allow for residents and you do allow for visitors, but you limit the access to your balance sheet, being like China or other major central banks. So there are ways of sort of controlling this, but of course, electronic and digital, it's even, in decentralized, even more difficult to sort of see it coming. Overlap between monetary and fiscal policy, helicopter money becomes facilitated this way. But as you said, I mean, decisions of subsidies, of emergency support, and other types of support are allocative decisions. And allocative decisions are for elected officials. So this is for fiscal policy, not monetary policy. If you have a sort of technological solution that facilitates for the government to do what it has to do in emergency, it has to be clear that the central bank is doing that on behalf of the elected authority and not on its own behalf. So I think there are ways of, it's not the technology that changes things, but of course, it's tempting. It blurs the limits between monetary policy more so than currently. So conclusion, central banks in Latin America and the Caribbean are very interested in CBDC. Benefits appear to outweigh the cost and the vision, cost and risk in the vision of the central banks. And of course, we do agree with this statement. Cost and risk, as we have discussed so far this morning, can be addressed through design and careful implementation. And benefits, if you're moving to this continuum and you're revamping your digital retail payment system, allowing 24/7, zero tariffs on this, then CBDC is the next step. It's an incremental move, not transformative, but the transformation is already happening, and CBDC will be one more step. And we mentioned a couple of benefits that CBDC could add to the existing landscape when you have digital retail payment system. Issuing CBDC, as we've seen it in the survey, is not an immediate development. It's going to happen. Well, 30% says that between 1 and 3 years we'll have a CBDC, which is higher than the global average, but still 2/3 say, well, we'll take more time. And here I think the vision of our institution is that do it slowly, gradually, very carefully, so that you can get it right, and because it has implications for central bank reputation. So just to finalize here, these two papers that I mentioned, the one in the left is the most recent, is Central Bank Digital Currencies, CBDC in Latin America and the Caribbean. Two colleagues from the BIS and Steve are the authors. It was released early this year. And on the right-hand side, you have the paper on the retail payment system, which I am one of the co-authors with other two colleagues at the office here. So with this, I stop here and look forward to our discussion.
Alexandre, thank you so much for that really informative presentation and for so nicely highlighting some of the results of our paper. Just wanted to raise one question for you before we go on. Especially given in Latin America with its long history of financial instability and dollarization, there are concerns that either the emergence of private cryptocurrencies or foreign CBDCs will basically cause capital flight away from domestic currencies. And I was wondering, do you view that as a particularly salient risk? And if it is, some central banks talk about issuing their own CBDC as a way to counter the flight of domestic residents from their own currency. Does that strike you as a viable strategy?
Yeah, I think that's the point. I mean, the survey does not reflect that. You saw the numbers, and it was financial inclusion, it was efficiency, but this was not high in the priority. I mean, to counteract the entrance of like stable currencies. But bilaterally speaking with central banks, yes, you feel it's in the air, this possibility, and of course, we have dealt with capital flows for many, many years now, even as a central banker, but also studying this phenomenon. Nothing replaced the macroeconomic framework. You have to have robust policies. I mean, you have to have, well, positive real rates also help in Latin America. It's also a need. Unfortunately, we have a sort of a stupidity premium that we have to pay. But provided you have your house in order, and then the currency substitution is less. Of course, you have shocks, you have funding shocks. The dollar funding can get you there, but I don't think this stable currency, crypto assets, it's been an alternative for diversification. We've seen like countries like Brazil, Colombia, and others. You see even the average saver looking into these alternatives, but more of a asset perspective, not so much in terms of using this as a means of payment. Of course, if you have the holdings increase a lot, I mean, the preeminence of the dollar has to do with the liquidity of the financial system here in the United States more than anything else, right? And if these holdings of residents grow bigger and bigger, larger and larger, then it becomes a means of payment. So I think, yes, CBDC of the fiduciary currency, of the sovereign currency, it's also an alternative to this potential developments.
Very good, thank you. So in one of your slides, you mentioned two of the fast payment systems that have been developed in Latin America. One of them, the PIX in Brazil, and the other in CODI in Mexico. And so now I turn to what I think you described as the father of CODI, Miguel Diaz, to present your views on CBDCs.
Thank you. Thank you. Can you hear me?
Yeah.
Okay. So after Eswar and Alexandre, and with very little left to say, so my planned slides wanted to go from general to specific. So I'll try to go fast as possible through the slides, and then just see the questions and answers, which might be more interesting. So let me...
Maybe you're not working so well. I heard you.
So let me start with the general overview of what is happening. So we're seeing an exponential situation in terms of the adoption of new technologies, and in particular, within the financial sector, we are starting to see that very, very much. So the point is, what should we do as central banks? We actually need to take these movements, and we actually need to adapt, and we need to be, we cannot be left behind. Otherwise, our mandates will not be fulfilled properly. So this is just a basic start of where we're coming from as central bankers in terms of analyzing and seeing how we can push forward CBDCs and other technologies. So this exponential drive in technology has focused particularly on one service. So payment services are a basic stepping stone, as Alexandre said, and they have actually been in the center of this revolution or in this exponential adoption of technologies. Why? From the perspective of the user, we all of us pay something every day. So this is something that is with us in our day-to-day lives. Then the existing services are not that great. So they're costly, they're inefficient, they're slow. And some similar services are actually given for free and very efficiently. So if you consider what a payment is basically a message that comes from an issuer to a recipient. And this message has some bells and whistles in terms of security and things like that, but basically, a payment contains a message saying you have to credit this account and you have to debit this other account. So it's a message, just like what you do with your messenger. This is exactly what we do. And people are starting to realize, why is my messaging system free and my payments are so costly? And then after that, you start realizing as a user that whenever you start getting payments and a history of payments, you can start getting access to credit, you can start getting access to other financial services that might be useful for you. So these are basic elements from the perspective of the user on why this technological explosion has actually come into payments. And when we talk about payments, digital payments, we have to realize that we are also talking about digital money. So in the past, this digital money has always taken the shape of M1. And M1, for those of you that do not know, is basically balances with the commercial banks. Now what we are discussing is whether we should take M0, which is monetary base, which is basically a liability on the central bank, and whether we should take this digital too. There are many things on the digital economy that we cannot buy with physical money. Now, if I want to buy something from Amazon or from some other provider, it is quite difficult to actually pay with a bill. And from that perspective, the service that we were providing as central bankers by providing these bills is no longer fulfilled. So we need to actually evolve and provide these tools to society so that they can actually start joining the digital economy with the services that we have been providing in a physical manner. From the perspective of the producers, there is also this very big evolution. Payment systems are very, very focused on networks. So if I have a very efficient payment system, but I only have 10,000 people on it, it will not be a very good payment system at all, because I could only pay to 10,000 people. But if I had a network of 90% of the population, even if my payment system is not that good, it would actually make a dent in the market and provide good services. So what happens from the producer perspective is that we already have these giant networks on different industries, if you wish. But these giant networks can actually be transformed and utilized for the payment system. This allows for the producers to actually reach the final consumers much more easily and on a cheaper perspective. And also the costs of providing this type of services have gone down very significantly. So if you see these like 30 years ago, the provision of an additional payment, a digital payment, was quite expensive. Now you can do the same with much lower fixed costs to begin with. And this allows for the entry of newcomers. And these newcomers can take the shape of a big tech, or they can also take the shape of a startup. The objective is how do we manage to get an ecosystem in which these two newcomers can actually come into the market and start competing on the ideas realm as opposed to the network realm. And here is where the central banks have a very significant opportunity to provide platforms to level the playing field and allow for everyone to join in and to make this ecosystem an ecosystem in which the competition is about the ideas and how good your product is, and not so much into how large your network is. So when we take the case of China, and we see Alipay and we see Tencent, this was a network externality. And these were clearly walled gardens in which if I had my account with Alipay, I could not pay to Tencent. So this is quite important. How do we manage to get a level playing field in which everyone can join in and the ideas and the products are what is important and not so much the technologies? What happened with this environment is that an unregulated entities started joining in to the party because it was so good, both from the perspective of the user and from the perspective of the producer. And they have competitive advantages because these are services in the digital economy. What you have is that you have almost perfect replicability of the services. So if I manage to produce a good service for a particular jurisdiction, I can just copy paste it into other jurisdictions and provide the same service. So we have the economies of scale element there. And we also had economies of scope in the sense that if I have already a big network, say I am providing messaging services, I can just write 2 or 3 lines of code and convert that messenger into a payment system. So this is quite important, and this is what happened with this technological evolution, and things started to develop very quickly. However, this development was kind of disordered. So everyone started joining in, and some of these services were actually generating the same risks as the risks that we have been trying to mitigate with the prudential regulations through the years. So if you consider, for example, a stablecoin, what does a stablecoin do? So they basically take a deposit from the general public. So I give $100 to a stablecoin provider. And this stablecoin provider gives me a digital representation of my money. From my perspective, that's not different from deposit taking. When I go to my bank, I give them $100 and they provide me with a digital representation of my money. The only difference is that with the bank, they have a lot of regulation to control that ledger from producing more money than what they can. And when we see these stable coins, we actually see the same service and the same risk, but we don't see the same regulation. So therefore, we start getting some troubles there. And then on the other hand, we have also the creation of some value, which depends only on demand and supply, of course. And this to me seems in some cases like the emperor clothes. So whenever demand goes down or a certain quantum vulnerability is found on one of these crypto assets, the value might go down significantly. And the problem with this is that not everyone understands this. So if everyone understood, then this is a free choice and everyone can decide to go there. But when you start talking about the quantum vulnerabilities and the cryptographic, the post-quantum elements that you have to embed in these type of systems, and you expect the regular citizen to understand this, we might get into some trouble there in terms of customer protection and the emperor clothes. So with this environment, what happened is kind of a Wild West environment in which lots of producers started doing things that actually generated some of the risks that have troubled regulators around the world in terms of just setting things well for the final users. And although it has not been the case, the generalized adoption of some of these elements might actually have impacts in terms of financial stability and also in monetary policy implementation. And this is something that Eswar pointed out. But so if you start reshuffling things, societies might start having less tools to mitigate economic shocks. So if we start losing some of the potential of monetary policy, then we start losing tools that societies have used in the past in order to mitigate this economic volatility, which has proven very, very useful in many decades before now. And so in the end, when you summarize all this situation, you see that you basically are covering many of the needs of the society, but then we have certain limitations that we have to be careful about. So now, what are we doing as central banks? And I'm going now from the general and trying to go to the specifics, and I'll try to go faster now. So central banks, we have been listening to what societies need. So we know that the digital economy is here, and we know that we have to provide services that are consistent with this digital economy. So we understand that universal access is of the essence. So many people have been left out, in particular in developing nations, many people have been left out of the financial system. And this is something that we need to take care about, because a person that is outside of the financial system will not fully take advantage of the digital economy. We need seamless payments, we need immediate financial transactions, we need personalized services, we need privacy within all this environment, and we also need this to be very low cost. As in many jurisdictions, even if you put a very, very low cost to financial transactions, people just stay out of the financial sector. And this is why the case of PIX and the case of CODI and many other systems around the world are basically offering services for free. And this is consistent with economic environment, with economic structure. Because if you see payments, what you see is that the marginal costs are equal to zero. So sending a message doesn't cost a lot. It's just a couple of bytes flowing through the internet. And this costs almost zero. This is why your messenger doesn't cost a lot of money. And this is why payments shouldn't cost a lot of money. Now, central banks in developed and developing countries are facing the same situations. Why? Because the trends are global. So as I said in the beginning, if you basically develop some solution for a particular jurisdiction, you could just copy-paste this around the world. So the threats and this disordered element, this disordered environment that we're facing is being faced by all the jurisdictions around the world. But there are a couple of dimensions that might be different, and my colleagues already touched on this. So it is not the same Uruguay, which made a very successful CBDC about 5 years ago. They were probably the first ones to actually develop a productive pilot. And they also talked a lot with the Swedish in terms of producing. Their objectives were quite different. And in the case of Uruguay, financial inclusion was so important. And also, there is a possibility for developing nations to basically leapfrog some of the development issues that they might have on their financial sector. And from the perspective of the developed nations, well, some of them actually have to maintain their role in the global financial ecosystem, so they need to keep up with the developments around the world in order to maintain those roles. Now, it is important that, so this is why I started with the general, because this goes all back to what the customer and what the final user needs. And from that perspective, it is quite important for central banks to actually provide solutions or provide environments in which solutions can flourish. So on one side, there is the functionality part, which includes the CBDCs, but there is also the obligation for the central banks and other financial authorities to actually set environments that will be secure, flexible, open to new innovations, so that we can actually generate conditions so that the financial system and the private sector can actually innovate. And a great example here is if you have a great idea and you have 10,000 people, that's not such a great idea in the payments realm. But if we manage to get the ecosystem ripe, so that this 10,000 person startup can actually connect to the wider network, we might give them a chance, and we might give societies a chance to get more innovative solutions going forward. And we're now facing a short window in which we can do this. So the objective is, how do we create these global digital financial public goods? How do we manage to get these platforms on which you can build on top of? And the private sector does not necessarily have the incentives to build these platforms. So if you see the case of China, everyone is trying to build walled gardens. So the network externalities from the perspective of the private sector is, I want to keep my network externalities for myself. When you see it from a societal perspective, the view is a little bit different, and the objective is, how do we manage to get these network externalities open so that ideas can plug in? So what we're doing is, many central banks, as Alexandre showed, are actually working, analyzing, and pushing this forward so that we could get the proper ecosystems for the digital society or the digital economy to flourish. And we need to actually generate this infrastructure on which the money, the M0 or the base money, can actually be used in the digital economy and can actually be programmable, as Alexandre said. And we have to provide some ecosystem in which decentralized finance is not necessarily something that has to go or to generate particular additional risks. So we might generate this ecosystem on which the base money, the M0, the digital M0, which is the CBDC, can be actually used to build on top of that different programmable services and different financial services on a standardized basis. So when you see the DeFi environment, it is very difficult to actually take one DeFi contract and then merge it with some other DeFi contract. That's quite complicated. If you have a base in M0, if you have a digital CBDC, and then you can build ecosystems on which these financial services can actually start to be more interoperable. Now, to take advantage of this, we need to put a lot of investment in. We need effort, technical capabilities, and lots of resources, and this is something that will take many years. But the nice thing is that this doesn't have to be done by each and every one of the central banks. So the characteristic of the digital economy is that it's replicable. So why don't we actually manage to join forces and start creating something that can be reused through the countries? And here is what one of the mandates of the Innovation Hub within the BIS takes place. So the BIS, as Alexandre explained, is like the central bank of the central banks. And it has many jurisdictions within it. So why not create an innovation hub on which we can create solutions, a little bit in the sense as Project Hamilton that the Fed actually published, in terms of just generating this and putting it in an open source, so that if any other jurisdiction wants to actually take that piece of technology and implement it locally, they can do so easily, and they don't have to spend the money in terms of developing the same thing once and again. So the three mandates of the BIS Innovation Hub are first to be aware and involved on this complex development of the financial technology. The second one is to try and generate some public goods that can be put on a shelf for any central bank to basically grab and apply on their jurisdictions. And the third one is to try and generate focal points so that different practitioners and innovators, both from the central bank community and from the financial ecosystem as a whole, can basically see and focus. And just one last slide, and I will not go into the detail, and I don't expect you to read this slide, but it's just there are three very interesting projects that my colleagues from other centers within the Innovation Hub have been working on. The three of them regarding CBDCs. So Project Jura, which was developed in Switzerland, is a delivery versus payment system in which you basically take wholesale CBDC and you take issuance of titles, and you can basically do a DVP without the counterparty risk that you actually always see with DVP transactions. The one in the middle, the NCBDC, is basically a way in which you can bridge different CBDC implementations on different jurisdictions, and you can basically allow for interchange of CBDCs within this platform. And Project Dunbar is quite similar, although using a different technology. So this is just an example of the projects that we have been working on in the Innovation Hub. Sorry, I took it back too early. I don't expect you, and it is not very useful for you to read everything, but these are just a couple of examples of what we're doing on the Innovation Hub centers. And more of this will continue to come, not just in the CBDC space, but from a much wider perspective on the digital financial public good realm. Thank you.
Yeah, thank you very much for that very provocative discussion and very interesting. I want to turn to questions from the audience, but before we do, I just wanted to ask you one follow-up question. When I first started looking at CBDCs, and I think when most people who think about CBDCs at all are thinking about them, they think of something that's very much the digital equivalent of cash, okay? And so it might be an account with the central bank, or it might be a token. But in either way, it's basically just like what's in your billfold, but digital. But what you've been talking about, and also what Alexandre has been talking about, when you talk about using CBDCs as a platform for kind of like sponsoring more competition in the payment space and more innovation, okay? It seems like it's a lot more than just the digital equivalent of cash in your billfold. It seems like you're talking about something more like a whole computer platform or payments platform, or something else that I am struggling to articulate because in my 30x years of doing macroeconomics, I've never dealt with this. So could you, in a few words, dumb down for the benefit of people like me, kind of explain exactly what you mean by this platform, and is this the way of is this really how CBDCs are likely to happen?
So you're right in the sense that it is more than just the bills on your wallet. This is a sort of an enabler that will allow you to actually, as a user, as a final user, to actually connect with the digital economy, and for the providers to actually join a platform that will allow you for these network externalities to be as wide as possible. So it covers the basic fundamental uses of the bills that you have on your wallet, no? But it goes a little bit further than that. And this going a little bit further than that takes into account the fact that when you have a bill, you have the widest network externality possible because everyone will take a bill from you, right? And from that perspective, if you actually generate a service that will take or provide the service on top of the physical bills, you can do that. No, it's open to competition. But in the digital landscape, it's a bit different. And in the digital landscape, sort of an artificial divide starts coming to place. With the walled gardens and the Alipay versus Tencent situation, some of these walled gardens start coming to place. And the CBDC actually could provide for this generalized platform so that everyone can just connect to and get the access to the giant network externality of having universal access to M0, as is the case with the bills in your wallet, no?
So in principle, if China could create a platform where Alipay and WeChat Pay would use as well, along with competition with other payments providers.
For sure. And it's a little bit like generating a connecting point. So you might get two giant networks that are separate if you put a floor to which both of these giant players have to connect to, then you have the network externality flowing immediately. And then if you have a very little network, that little network also connects to that floor. And through that connection to that floor, they have access to the two giant networks. So that's a nice thing of it, that you're allowing for the smaller guys to actually compete on a level playing field with the giant guys from the network perspective. Of course, there are many other things that have to be tackled by the competition authority, but at least from the access to the ecosystem, you get this very nice advantage.
Excellent. Well, you've put a lot of food for thought on the table. Why don't we turn to some questions for the audience? Let me mention that we're allowed to go a few minutes over if we need to, but let's try to keep our answers concise. And when somebody has a question and raises their hand, like that gentleman there, one of our staff will provide him or her with a microphone. And if you could just state your name and maybe where you're from and then your question.
Yes, my name is Roger Cochetti, and I wrote an op-ed on this subject about a year ago for The Hill when the industry, the technology was a lot less mature. But I really, if I may, have two questions, one for anyone on the panel and one for Mr. Prasad particularly. On the 800-pound gorilla in the room that has not been very much discussed is the potential of these digital government, central bank digital currencies to enable totalitarianism. It's clearly the most controversial, politically controversial aspect of this. And this is beyond anything even George Orwell could have imagined. Mr. Smith, you have spent too much money last month on entertainment. This month, your quota for entertainment is reduced to 1 kumquat. Or the Presbyterian Church may no longer have any kumquats, nor may anybody contribute money to the Presbyterian Church because they have been treasonous or blasphemous. Or the capability it gives to governments is unimaginable. So I hope anyone on the panel would discuss that. For Mr. Prasad, it's clear that by a wide margin, the most important experiment occurring in the world is the Chinese experiment right now. And you touched on one absolutely essential aspect of that, which is that it enables both a banking system and a central bank digital currency to coexist. And I don't quite understand how that can happen, because the central bank doesn't need the commercial banks and the consumers don't need the commercial banks. So other than bribery or paying off, helping my brother-in-law keep a job, why would the enormously important financial sector that we all know today, how could it survive central bank digital currencies over any period of time? Thank you.
Excellent. Why don't we let Eswar start, since one of your questions to you, and then our other two panelists, feel free to opine as well.
If you think about the notion of central bank digital currency, it's still seen by China in particular, but more generally, as a complement to physical central bank money. So it would be non-interest bearing, it would be a liability of the central banks, it would have very different characteristics from a bank deposit, although as both of my colleagues have mentioned on the panel, it would have some similarities in the sense that it could be used as a payment mechanism. But in fact, this two-tier approach does envision the existence of CBDC digital wallets that are maintained by commercial banks at the front end. So those would be maintained in parallel with deposit-bearing accounts. So the commercial banks, not just take deposits, but they also create money, as you know, in modern economies when they create loans. So that function would remain with commercial banks. And I think there is a case to be made that so long as you have central bank money being non-interest rate bearing, you will still have commercial banks in existence and continuing to fulfill their traditional functions. If you do have CBDCs beginning to bear either positive or negative interest rates, then you have a game changer. Certainly that could affect the balance, and I think that would move us to a situation that no central bank and nobody wants, which is one where the central bank might start taking in more deposits than it intends, where the commercial banks get disintermediated, and then you have the central bank in the position of allocating credit. That would be disastrous for central banks, the government, and the economy, and I think there are safeguards that can prevent this from happening. On the dystopian world that you pointed out, in fact, I do have a section in the paper in my book, about this. Certainly one can think about programmable money being used not just as an economic tool, but as a tool of social policy. Here again, I think technology is giving us some ways to mitigate some of these risks. Let's take China as a perfect example. In China, there are 5 grades of digital wallets being created. The highest grade digital wallet, which could be used to maintain large balances, could be used for large value transactions, would have to meet know your customer and other requirements. But the lowest grade digital wallets you could get just using your mobile phone number. In China, you might say if China Telecom gives you your mobile phone number, you have no privacy still. But the notion is that actually you can use these low grade digital wallets in a manner that gives you a transactional privacy. Those can be used only for low value transactions. You can hold only low balances. So in fact, technology is giving us a way of mitigating even the privacy risks. But certainly there are concerns that once we move to a world where everything is digital, we not only compromise privacy, but again, where central banks become instruments, not just of monetary policy, but of broader economic and social policy. That is a dystopian world that I think it's worth us thinking about. And this is why I think the Fed is very wisely moving cautiously on this.
Yeah, well, I think this is quite a crucial issue, data protection, confidentiality. I don't think technology will say where we go. I mean, technology can facilitate this dystopian world that you mentioned. Technology can mitigate it, but at the end is a decision of the society. So it's up to Congress to decide what kind of protection, you want to grant data. Yes, I think if we look at the today, I mean, most of the transactions are electronic anyway. Most of the transactions leave a trace. And if you have a court order, you will have access to those transactions. I think the same model should be replicated in the CBDC, but it's up to Congress, it's up to society to decide what kind of access. So we're talking about today in most economies, the digital footprint, the cash footprint will be around 10%. So 90% is digital, 90% is traceable, 90% is subject to an injunction, and at the end of the day, you can identify who is there. So if you think of the CBDC as a cash footprint going forward, and if you see technology can exacerbate this issue, but it can also mitigate, but at the end, I think the Congress has to decide what society wants in terms of data protection, who controls the data, which personally I think the user has to be the one that owns its own personal data. And there are technological issues, and Miguel knows much better than I do, but separating personal data from transactional data, so you can protect. But this is not a technological issue, this is a much wider one.
Neil, do you have anything to add?
Not so much. I agree with both my colleagues. And so technology is there to enable what societies want. So if you live in a totalitarian society, then this could actually fulfill those horrible worlds. But if you live in a free society, then you mandate your central bank to actually develop technologies that will protect the privacy of your users. And this is very important. There is a trade-off here between the privacy and the potential use of your own data in order to get more access to the financial services. So from that perspective, one of the discussions here is whether the systems should block completely the information gathering part of them, or whether this should be designed so that the final user, the individual, can basically take that information and share it whenever he wants. And this is a possibility. The technology allows for all of that. And just one more element in terms of the disintermediation of banks. When you see the core business of the bank is to take deposits and lend, no? And usually what happened in the past is that they had to offer a good interest rate so that people would come with their deposits. Now, with the existence of payment systems, some of the banks started to get a very nice business out of just settling transactions on the payment systems realm. And as I said, the marginal cost of producing these services is zero. So we're just providing an alternative for that part, for the payment system, but not for the credit granting. So this might even push the banking sector to actually do a better job in terms of intermediation, in terms of providing better rates to get the deposits in and do their intermediation job much better. So it is not clear how it would work, but there is this possibility of actually getting even more competitiveness into the banks and providing banks with the incentive to give better services.
Great. Any other questions? Why don't we take one at this end of the hall? Sir, if you can, yeah. And
thank you. So my question is about digital identity. How are central banks thinking about this? And if you could speak a little bit about the India stack, maybe explain that for the audience if they're not aware of it, that would be super helpful. Thanks.
Great. Not everybody has to answer, but somebody should answer.
I'm happy
So
to.
I think digital identity is of the essence for the provision of these, and in particular for those services that will generate for larger movements of money, where you have to actually know who's moving the money in order to get anti-money laundering and counter-financing of terrorism. And you have to get a digital identity element to that. So the functionality is fundamental for both the banks to actually know who they're dealing with, but also for the person to actually manage their identity the way they want to. From that perspective, the Indians are like 20 years in the future as compared with everyone else. So they have this system called Aadhaar, which basically gives identity and identification to all of the people within India. And it is a very efficient way of actually providing that service that can be taken both from the financial sector perspective, but also from other sectors and other industries. But you're completely right. This functionality is of the essence for the financial system to work properly. And we need to develop infrastructure that will allow users to use their identity with the financial sector providers in a much more efficient way for the digital economy.
Eswar?
So the India stack, just building upon what was said, has three elements to it. One is the identity rail, which is based on biometric identification. The second is the payment trail, which you very nicely characterized as this sort of foundation that you can have different networks operating upon. So unified payment interface essentially provides that payment infrastructure. So this is a public good provided by the government, but it allows the payment services, again, to be provided exclusively by private payment providers. Then the third is the identity, the data rail, which is really crucial because, as was pointed out, it's really important to give people the ability to control the data, but also to use it in an effective way. Because if you use payments data, much like many of the Chinese payments platforms do to build credit scores that they can then use for providing credit products, you want to be able to use your data, but the crucial point is that you should be in charge of who gets to see the data. So India is setting up data aggregators who would be managed by the government, or at least licensed by the government, and who would then give you access to the data and the ability to use it. So I think you're right that India has gotten many things wrong, but this is one thing that is getting spectacularly right. There are still some implementation challenges, but I think the design is a very sensible one.
Well, it's always good when a government gets something spectacularly right. We're at -1 minute now, but I'm told we have a few extra minutes, right? Great. Jard, is that you? The gentleman over there? Yeah.
Hi, thank you so much. My name is Dimitris Rakitsis.
I'm sorry, I confused you with you.
No problem, no problem. I have the following question. So following the recovery from the pandemic, a lot of central banks are now called upon to face inflationary pressures and therefore, if not already, have quickly embarked on a monetary policy tightening cycle. And my question was the following. Obviously this monetary policy tightening cycle creates interest rate differentials between, say, those who are called upon to quickly tighten, mostly advanced economies for the last few months. And the topic of today, of course, is emerging market economies, consequently having implications for those emerging market economies. Now, my question is, and I'm not sure if there's any theoretical research on that, is there any way, any chance that the interaction between CBDCs and, let's call it, regular currency could lead to some kind of hedge in terms of protection from rising interest rates in advanced economies, which for emerging market economies, in particular those who are pegging their currencies to advanced market economies, particularly the dollar, will probably feel stronger effects. So could there conceivably any way be foreseen that CBDCs could be used or tweaked in a way? I mean, we heard about expiry dates, for instance, from Mr. Prasad earlier. Again, all theoretical, right? But could there in any way be a feature conceived that would enable CBDC holders to mitigate the effect from interest rate differentials coming from advanced market economies' rising rates?
That's an interesting question, I should say. I mean, haven't thought about it. So if I think of CBDC being cash, 10%, no interest bearing, so I don't see the connection. Of course, you alluded to interest rate differentials. You see here in the region, in Latin American, Caribbean, central banks moving ahead of the pack in terms of normalization, if I may say so. So there has been an interest rate differential in favor of the countries in the region. So you've seen lately some appreciation of their currency together with the commodity issue and so on and so forth. But going back to the CBDC, I don't see it now. What I see is that some countries, for diversification purposes, And you see even average investors are looking for crypto assets, be them stable currencies, be them simply without crypto assets without backing, as a way of sort of diversifying their investment. So materially, this could have an impact going forward if it gets more traction. So it could cause, make capital flows even more volatile. But CBDC shielding from interest rate differential, thinking about CBDC, a non-interest-bearing instrument, is like cash today. I don't see the connection, but maybe some of my colleagues can see something that I'm not seeing.
You could imagine a CBDC whose interest rate moves up and down with, say, the US interest rate, but then that would be like pegging the currency,
Yeah,
which is
but then-
another story. Why don't we take one question from our virtual audience, and then we probably need to wrap. And then after that, maybe each of you could spend a minute just with some final concluding thoughts. But we had several questions from the virtual audience. One I'd like to mention is there was a question about whether CBDCs have implications for the lender of last resort function of the central bank, and as a related matter, whether it obviates the need for deposit insurance. So would either of you like to address either of those questions?
If I may start, I mean, you have to design this new means of payment carefully in a way that you do not generate like more susceptibility to bank runs, in a way that you do not disintermediate the financial system as we know it. So, because if you do it a hasten development and yield design currency, then it might have an impact on the lender of last resort, because you're going to have banks failing because of they have to fire sale their assets because of people are exchanging their deposits for CBDCs. And then you have to deal with a lot of some liquidity issues, some solvency issues in the financial system if this CBDC is not well designed. So in this sense, CBDC could have an implication on the lender of last resort, because then if it's a liquidity issue, maybe the central bank will have to step in. Or if it's a solvency issue, you have the deposit insurance kicking in. So I think the deposit insurance is particularly important in this new phase. You don't want to eliminate. If you eliminate the deposit insurance, then you don't have a financial system anymore. So we have to strengthen the deposit insurance. Okay, the deposit insurance has to be credible, so to avoid the people like switching from their bank deposits, from their private money, which is a claim against commercial bank, to the central bank balance sheet. So deposit insurance has to be stronger. CBDC has to be well designed, otherwise you have lender of last resort implication. You don't want to, you want to do no harm with this thing, right?
Any other comments on that?
Just one general one. When you see the ecosystem as a whole, you see different banks within this ecosystem. If one of these banks starts having a problem, then the flow of money from that bank to the other banks is digital, and it should be very fast too. So the difference between that and having the possibility of switching to all the other banks or to M0, it doesn't make so much of a difference. When you see it as the whole banking sector and you think a run on the whole banking sector, then you do get this difference in terms of the possibility of actually running from the whole banking sector. But in the short term with individual banks, the difference between having this possibility of running to M0 as opposed to running to more credible M1 forms, I don't think there is such a big difference in terms of short term. But I agree with Alexandre in terms of the system whole perspective. You do get an alternative of flowing from M0 to M1, and that might be an issue.
All right. Very good. Well, why don't we maybe, Hiro, 1 minute, what do you want to leave our audience? What message do you want to leave them with? Maybe starting in with Eswar and moving this way.
Okay, so change is coming in the way that money is managed in the way in which we all interact with each other in financial terms. And some of this is going to be very positive. I think there are huge improvements coming in terms of both domestic payments and also international payments, and there are going to be many benefits in terms of broadening financial inclusion, making it easier for economic migrants to send remittances back to their home countries, integrating global finance, but there are going to be enormous risks as well. And Alexandre pointed out that technology is not going to solve all problems. It may end up creating even more new problems and drifts in society, and so long as we don't deal with fundamental issues such as disparities in digital access, financial literacy, and so on, all of these new technologies might lead us not to a promised new world, but to, I think, a much more complicated and more divided world. And ultimately, I think this discussion raises a whole set of issues about what the right role for the government is in society, because again, digital money does provide a lot of opportunities, but as we discussed, there are some potentially dystopian futures also that one can envision. So we're going to have to talk about all of this, not just as an economic or technocratic matter, but really at the level of our societies.
Yeah, just to say that I think central banks are responding to this demand for digital money, including. And as Miguel has pointed out, I mean, lots of the digital services are free. Why should a message that carries a money order, in a sense, should not be free? So central banks are responding. They have done a lot in this part of the world on the digital payment system, 24/7, zero cost or very low cost with the private sector, with the enterprises. And now, why should they take the additional step? So we have seen this morning that there are some incremental benefits. Another one is using this fiduciary digital currency in the DeFi ecosystem. Why do you need to have a stable currency, sort of with a bunch of assets frozen to guarantee a value, if you can have the digital fiduciary currency doing that? Why should you sterilize 200 billion in assets, where these assets could be managed and liquidity elsewhere in the financial system? So this is important. But my final word is, when you think about retail CBDC, and this is where this region is favoring in terms of implementation, I think the landscape is still very open. Okay, you are lots of alternatives. You have many vendors entering the space, offering facilities, and so I think an institution like the BIS, and here Miguel, I think, has a very important role to play, is to sort of help the central bank community navigate this open field, which is quite open, and we are studying this, and we are, together with the central banks, helping make sense out of this wealth of alternatives and information going forward.
From my perspective, I think we're living quite interesting times. If you're a central banker, you're faced with lots of challenges that we have never faced before. And we see many roads open, just as Alexandre said. And it is important to share with societies that central banks are not standing still. Central banks are analyzing and doing lots of research and efforts into how we tackle the new challenges that come with the digital economy. And examples of this, of course, are in most of the central banks that are doing this work. The BIS, for sure, with the innovation hubs, but also within the Americas office, we have this consultative group on innovation and the digital economy, which Alexandre created. And what we're trying to do is to actually generate products that can be used, and in order to fulfill these needs of the final users of society. And I believe that is the way forward, to provide these platforms and to provide things that can actually allow for the ecosystem to develop and for the private sector to have a level playing field, and so on. In the past, it had not been necessary to create this type of infrastructure because the technology was at a stage on which it did not require this. Now the technology requires us to step in and to provide this type of infrastructure as central bankers and as international organizations with the BIS in the Americas, but also the BIS more widely.
Well, I'd like to thank our virtual audience for tuning in, our in-person audience for actually coming in person, and most of all, thank our expert panelists for taking time out of their busy schedules to share with us their insights and views on this important topic. So hope you all learned something. I certainly did, and let's give our panelists a good hand.